Okay. Hi, good to see everybody. Glad to be here as always. Okay, very good. Okay, how to improve your trade selection using direction and pattern with myself. Always good to see everybody. We need to put a disclaimer on it. Trading futures and forex is a risky endeavor and not suitable for all investors. Likewise, the techniques I demonstrate are proprietary and should not be retaught or retransmitted for any reason. My name is Jay Norris. I'm a 20-year trading floor veteran of the Chicago Board of Trade. All that to say, I've been around some. In many ways, trading is much better now on the screen than it was then on the floor. Certainly, the cost of to get in the game much cheaper, significantly cheaper. I'm amazed at the technology, the jump to the charts. I mean, so many people have free charts now. We always had to pay. If you had charts at home, you had a home office or you went up in the office off the floor, charting package was pretty expensive. It was like $600-800. Now it's free. I mean, MetaTrader's free. So, in many ways it's better. Actually, you learn a lot on the trading floor. What I did appreciate about the trading floor is it taught you how to think about trading. You were surrounded by people who made money every day. Otherwise, they wouldn't hang around long. And that was probably the biggest difference. And that's a big difference for people. You need to see people making money. It's going to go a lot easier for you. I think you're going to pick things up quicker if that's the case, if you could see it demonstrated. I love the trading floor itself. I love the people I met, but I really don't miss it though. I've written a couple of books on trading, which were published by McGraw-Hill. The tactic we're going to show you today is highlighted on the book on the right, Mastering Trade Selection and Management. What's unique about these books is that they include trading plans. Excuse me there, I almost had to sneeze. What is unique about these books is that they do include trading plans which allow you to backtest the information provided. Transparency, always important for all of us. I'm big on method. You have to have a method for yourself. I mean, there's just no doubt about it. You have to have a robust trading method, and it has to work in all environments. You have to have that method. I can't speak enough on it. That you have to have a method that you can go in and test how it's working in any market, in any market time frame, in any individual market, or collectively, multiple markets. You have to have that. Without that, it's awful hard to imagine success on a day-to-day, week-to-week, month-to-month basis. Sure, you can get in an environment where you have a bull market and it's just buying dips, and it could seem simple, and it is simple too if you're in the right place at the right time. But overall, to be consistent, you're absolutely going to have a method that you can follow, and that method's not going to change. Ideally, it'll work in all environments, and it took us over 4 years to create that trading method that we teach at Trading University. It's objective, it's empirical. You can pretty much operate it in all trading environments, meaning up markets, down markets, sideways markets, regardless of the shifting fundamentals, regardless of the day-to-day news, and that's extremely important. Day-to-day news flow, there's no doubt about it. That's going to be key. But again, I'll wrap it up. But I can't say enough about having that method. And the goal of the method, your goal as a trader, also is not necessarily what you think. Your goal as a trader, yes, it's to make money. But why are you doing that? Why are you trying to make money in the marketplace? Well, you want peace of mind. You want longevity. You want stability. You want peace of mind. That's why we work, is peace of mind, right? So you have to understand that if you're trading now and you're having some success, or you're not successful, and you're overly agitated and you get too excited and you even suspect it's not healthy for you, then you have to back down. You have to back out of that tunnel you're in. You have to take a new approach. You have to change the way you think, because trading should lend itself to peace of mind. It's amazing how many thoughts that we have over the course of a day, let alone how those thoughts can accelerate in our minds when we start to trade. And I'm going to tell you right now, most of those thoughts they're worse than useless. They're going to get you in trouble. They're going to get you to do the wrong thing. So you have to understand that. And the way you're going to do that is have a method that you've seen demonstrate that works, that you can demonstrate for yourself that works. You get the point, right? It's got to work in all environments. Our method, which I'm very proud of, as I said, it took us 4 years to come up with really that holistic method for counter-trending and trending markets. What makes it unique is it combines both mechanical studies and the behavioral aspects, both extremely important for us. A mechanical aspect, here, let me give you an example of that. Let me find this very quickly here. Bear with me. As I said, I had to reboot the computer and vacuum all the dust out of there, cool it down. So let me find this, what I wanted to show you. As given an example of something mechanical, and something mechanical is that you can count on. It's the same every time, and you can count on that. And we use a mechanical tool to essentially tell us which market to trade and which direction to trade it from. And there it is. We call that our risk tolerance threshold ratio. It's just a ratio. We take the different markets. For example, you can see the Aussie, all the patterns are up. That may need to be updated now. You may have had some downside there. But, well, here's an interesting one. The pound, if you look at the pound, you can see you actually still have one pattern up. So the majority of patterns are up right there. So we may be interested in buying dips in the pound. Maybe I spoke too soon. It looks like it's trading below a level now. But at any rate, this is what I'm talking about as a tool that's going to help you identify how the markets are positioned. That's going to help you greatly as far as which market to trade and which market to trade from. You can see the euro actually leaning bearish here now. And that's an example of a mechanical study. And that's not going to change. So in determining what a market's patterns are, what the direction is in a market, that's all very mechanical. So you need to have that mechanical aspect. It's essential, because that's not going to change. We all know conditions in the market are going to change. We all know our thought process in the back of our head is going to change too as the markets go up and down. It's amazing how we think that we're seeing things. We're always leery of reversals when, let's face it, reversals really don't happen too often, right? Every time we think there's one, especially when we're beginning to trade, every time we thought there was a reversal, it just turned out to be a correction. And we thought, why are we getting short every time this market goes down? Because we think there's going to be a reversal. If we could just turn that around and get long every time there's a correction, boy, wouldn't that be simple? Well, we think it's simple, but funny thing about trading is, right, it's not as simple as it seems. You get the point. My point being, you need a mechanical study that's going to help you identify whether a market's bullish or bearish. Now, next, behavioral aspect. You have to have a behavioral aspect to your trading plan. The behavioral aspect is going to determine when you go into a trade, where you put your stop on that trade, how you manage that trade. I.e., do you put on multiple contracts? Do you come out of a portion of your contract at a little bit more than you risk and then go with a break-even stop and then manage maybe the second half of your position using a momentum indicator such as the MACD? Those are all behavioral determinants. So in my world, you have to have a combination of those. You definitely have to combine both the mechanical studies and that behavioral aspects of it. I remember back to one of my earlier mentors, Bill Williams. Bill Williams was trained as a psychiatrist. He was also studied quantum physics. Very, very brilliant man. And he was good friends with Larry Williams. You guys probably heard of Larry Williams. Larry Williams was a trading guru, I guess you call him. He sold trading courses. He gave shows. Larry used to trade like $1 million account. He'd give any profits away to the students who showed up for his webinar. So Larry was a bit of a showman, but nonetheless a good trader. Larry relied completely on mechanical studies, though, and Bill relied almost exclusively on behavioral studies. And these guys used to argue a lot. They were good friends. They both lived in Southern California, and they'd go to dinner with their wives, etc. Their wives were good friends, or I was going to say maybe their wives took them to dinner. I don't know if they had a bad week. I don't know. That's a joke. But anyway, Larry championed mechanical studies. Bill Williams championed behavioral studies. And they always had this ongoing argument, and Larry would tend to win the argument because he'd say, yeah, Bill, but who sold more courses? Well, Larry sold a lot more courses, but I think in the long run, Bill won that deal because Bill was a heck of a trader, a great trader. And I learned from Bill. I learned the absolutely you had to have behavioral aspect to trading, but at the same time, you can't rely on your intuitions the whole time. You have to have a mechanical aspect to it, and that's why I'm very proud that we combine these two. The mechanical aspect to tell you which market to trade, which direction to trade it from, the behavioral aspect to show you when to trade and how to manage the trade. I think it's essential if you're learning to trade, if you're choosing an educator or a method, that you have both those aspects to it. And also, probably the most important thing is that method is easily explained. It's simple. Big difference between something being simple and easy. You can look at a chart and it seems simple to you, but you try to execute it and it's anything but, because you bring in money and you bring in risk and you bring in all those good things, and we don't know what behavioral system you already have in place. And that behavioral system you have in place now for you individuals, that behavioral system may have been in place a long time. Again, it's simple to show you something, but it's much more difficult, definitely not easy to get you to execute something, right? And it's a funny thing how, things that may have happened to you 10, 15 years ago have a big effect on how you view things now. But we're not talking about you, we're talking about the method that we teach right now, and it's essential that it be simple, easily explained. And by that we mean that you know exactly what studies it's based on and essentially why the method works. Because once you know what studies it's based on and why it works, it's going to be a lot easier for you to grasp that. It's going to be a lot easier for you to absorb that and make it a part of your trading philosophy. For example, I know that my method is based on fractal geometry. It's also based on what we call risk tolerance threshold theory. Risk tolerance threshold theory means that every one of us has that risk threshold point where we're going to capitulate on our trades. As long as you have a position in the market, I guarantee you have a point on that chart where you're going to capitulate, and you may not want to capitulate on that. You just may capitulate because, hey, that's you can't take the pain anymore, right? So our method's based on risk tolerance threshold theory, which is something we teach in the courses, and it's also based on fractal geometry. Fractal geometry being markets are definitely scalable. There's no doubt about it. That they're scalable, and they're also repetitive too, which is a very nice thing, and we'll show you examples of that. So if I had to summarize our methodology, I would say that we focus on markets with low non-systemic risk and look to trade at those times when the day-to-day news flow is aligned with the primary or secondary patterns. That's pretty simple for us. That's pretty straightforward. And currencies, of course, are low. They're markets that they have a lower non-systemic risk. Certainly, there's systemic risk to any market, but it's not like a stock where you can come in one day and the Aussie will be down 50% or something crazy like that, right? So you do have that element of a lower non-systemic risk to currency markets. And we also look to trade at those times when the day-to-day news flow is aligned with that all-important primary or secondary pattern. We'll give you an example of that. This is the euro US dollar back in December, and you can see the secondary pattern was up and the day-to-day pattern was up. See that little purple line right there? All that is a 50% retracement of that move. So you have the 50% retracement right there, and that's all that is. Very simple. So when you see the day-to-day patterns up and you get a 50% retracement and the day-to-day pattern remains higher and in line with the secondary pattern, you know that that's an area in the chart where you want to be going long. And this is a part of the mechanical aspect of what we do. This is a daily chart. You probably see it a little more clearly on a 4-hour chart, but hopefully you can make that out. There's a little double bottom there, right? So regardless of what you think the pattern is, regardless of you may see a lot of resistance ahead here, you may be reading things in the news that the euro shouldn't be going higher, but you need to know, at least know mechanically, whether you take the trade or not, you need to know mechanically that you have the day-to-day pattern up, you have the secondary pattern up. So when you get what we call a change of direction, short term, in line with those two powerful patterns, you need to know that. So keep it simple, no doubt about it. It's going to be a lot easier for you to trade if you know those higher time frame patterns are aligned. Okay, first you have to know that the higher time frame patterns are aligned, and then once you have those aligned, you need to know that you need to trade in that direction. And again, it's a matter of that. By the way, the day-to-day pattern, which we're referring to there, that's also, we call that the day-to-day news flow. Your day-to-day news flow, generally show me a 4-hour chart that goes back a month or so, and that day-to-day pattern should pop out at you. And generally that day-to-day pattern is going to be a reflection of the day-to-day news. So if you're not quite sure how to read the news, that it would be intermediate term news that's influencing the market, it's usually a good idea to pull up that 4-hour chart and scrunch it up and see what's going on. Ahmed, very good point. Yeah, the market's been 80% of the time ranging and only 25% of the time. That's correct. Oh, no, absolutely not. Here's the beautiful thing about markets. Most people are afraid of lower time frame, what's happening on a lower time frame chart, because they don't fully understand that, because things come a little bit quicker. And we're all taught, hey, it's really almost textbook. It's really textbook knowledge that people say, oh, trade the higher time frames. Well, that's true if you're a position trader or a swing trader. You do trade the lower time frames. However, markets do not. Yes, on any individual chart, a market spends the majority of the time going sideways. In these markets, it's probably closer to 70% of the time, Ahmed. But if you scroll down low enough, you will find a trend trade somewhere. I'll give you an example of that right here. Let me go to my charts here. Well, I love that we don't have to switch charts anymore, right? I could switch to a live chart, and you guys move right along with me. Remember before I had to switch everything and keep up with. Here, I'm going to give you an example of a market that, and this is dollar yen, by the way, right? So I think we'd all agree. Let me scrunch the chart over there. It looks like dollar yen right here is kind of going sideways, right? This is an hourly chart. And this is this morning, by the way. Dollar yen's going sideways, right? At that point, not a lot going on. Let me pop all the way down to a tick chart or even a 1-minute chart. And most people are afraid to go down this low. I'm not, however, because I have a bit of experience in this, but I'm going to show you a very nice little trend that was in the European session today. And I'm going to show you how predictable that pattern was. There we go, so I can scrunch it up. And this is dollar yen in the European session today. Hopefully you can see the time frame chart there. That's Central Standard Time, I apologize. But this is the European session today. What I want you to notice is this retracement right here, this first retracement right there, up, down. We call that Mandelbrot generator. I think we'll get to that today. Let me just mark it. See that little AB pattern right there? You take that retracement right there, and it's going to be the same retracement here as it was here. And this is the dollar yen today. Take this retracement where it stopped there. That retracement there is the same as that. So these are almost identical moves here. Rally, correction. Now, at the time, this trend was truly sideways here, right? But when you made a higher high here, see the market here, it made a higher high to that. Once you made a higher high, then that market was breaking out, right? But it still kept the same pattern where you had, I'm just going to duplicate that because it's easier. You get the rally, and then you get the retracement. I'm going to duplicate that. Trying to duplicate it. Well, it's not going to let me. At any rate, you see where I'm going with this, right? You have a rally, then a retracement, then a rally, then a retracement. So all this market, it looks like this market's going sideways on the higher time frames, but look at that. You had identical pattern. Boom, boom, boom. Now, it doesn't look like much. You say, well, what good is that? 6, 8, 10 pips. What good is 6, 8, 10 pips going to do me? Well, if you're in a futures account, it's 6 pips in a futures account is $72, right? If you're in a yen futures, that's $72. You got a 2-lot on, that's $140. $140, $140. See where I'm going? It's adding up. Or even if you had 2 standard contracts, you may squeeze 8 pips out of there, but you got to remember your pip spread is almost 2 pips there. So even there, if you could squeeze 6 pips out, that's $120 on a 2-lot. So 120, 120, 120. What I'm getting at is it may be going sideways in the higher time frame, but if you're in a market where you're confident that the majority of patterns are higher, such as they happen to be in dollar yen still, there it is. There's dollar yen. You can see all those influential patterns are bullish. So if you're on a low enough time frame, boom, boom, you could take advantage of that. And then what happens here? I'm still not sure what the news is, but when that news came out, we were live. I said, hey, look. Bam, that's a big move. I know it's a big move. It retraced more than that retracement. See that ratio? Bam, bam, bam. 3 ratios in a row. That's a good solid pattern. Once this rally retraced more than that retracement, more than that ratio, and on as fast as it did too. Once you retrace more than that, here, I'll give you an example. Once you go beyond that point, beyond the previous retracements, you have a pretty good idea you're into a new pattern there, right? And at the time I said, whatever news it was that did that, we kept checking the wire. We could find no news. Something for nothing today. When you see a big move in the market, when you see the market gap down and you can't find the news, you can't find why it did it, you better get out of the way. You better understand that if you don't know the source of the news and that market's moving on it, you better get out of the way. Ahmed, great point. Most day traders lose money. That's correct. We count on that, and we count on them losing money, right? 10% of the fishermen catch 90% of the fish. That'll never change. That's just how it goes, right? So yeah, we count on most day traders losing money. Most day traders, they're looking for a reversal. They're always looking for a reversal. So they're short here, stopped out here. Short here, stopped out there. You have to understand that pattern, and you have to go with it. So back to the slideshow, and this is a great example in the euro. The long term, you have to know how those patterns are aligned, and you have to know your strengths as a trader also. Initially, most people, they shy away from day trading. Well, they're told to. They're trading, oh no, you can't day trade, you can't trade those lower time frames. I would agree, you need to learn how to trade on a higher time frame first. Absolutely, everything's going to make sense to you. But here's the beauty of fractal geometry. What happens on the higher time frames is replicated on the lower time frames. It just happens a little bit quicker, that's all. So things happen a little bit quicker on those lower time frame charts. But yeah, it's essential that you do learn the higher time frames first. But once you grasp that, to me, that's part of my philosophy. That's ingrained in me that I know what I just showed you on that 1 minute chart in the yen is the same way the yen is going to behave on the higher time frames also. And that's just how markets move. So our point here, though, is that you have to understand how the patterns are aligned. You have to have that mechanical aspect of it because it's going to give you tremendous confidence when it comes time to make the behavioral decisions such as when to get in the market and how to manage that trade, where to put the stop. Behavioral aspect, essential. Trade management, essential. But what's going to give you the confidence is the mechanical aspects of it. How are the patterns aligned? The one feeds into the other. Neither one is more important. I think Bill and Larry, with their argument about that, I think they kind of missed the point because I think if you combine them, you're going to be a better trader for it. Bill made more money. Larry sold more courses. So I'll take Bill, right? I'll take the money, right? We also could trade shorter term, and I'm glad that Ahmad talked about that, the importance of knowing that markets spend the majority of time going sideways. However, if you scroll down to the lower time frames, it just depends on what time frame you trade on. I was showing you that 1 minute chart. Regardless of it being a 1 minute chart, I'm still focusing on, the reason I'm focusing on that 1 minute chart is because I know that I have that 4 hour, that 60 minute, and that 15 minute are all higher. So if I have all those lower time frames higher there, then I can scroll down to that 1 minute chart and I can try to make hay there, right? So here's before I gave you our here I'll go back to this slide. We defined our overall methodology where we look to trade when the day-to-day patterns align with the primary or secondary, and then we showed you an example of that when the primary and day-to-day are aligned. But we'll also trade the lower time frames. We can focus on markets again, low non-systemic risk, i.e. currency markets, and we can look to trade at the times when the micro patterns are aligned with the day-to-day news flow. And that's how it was early. That's how it was in the London session today for the yen. The micro patterns were aligned with that day-to-day news flow. That day-to-day news flow, by the way, is a reflection of our day-to-day pattern. So that day-to-day pattern is up here. It's up here. That's important for us. Even the euro here, you're starting to slough off there, but the day-to-day pattern is still bullish. That day-to-day pattern reflection of day-to-day news flow. Right? What happened yesterday in the euro? News came out about Mario Berlusconi not running, and that was the news, and it happened to be bullish for the euro. So you're still at a point where the news flow is still the day-to-day news flow is still bullish. Therefore, the day-to-day pattern is bullish because pattern absolutely is a reflection of the news flow. So we teach our students. Many of them they start out, they want to swing trade, they want to position trade. Some of them work for a living, they don't have time to day trade. But then when they see that they have the ability to do that, then we'll encourage them get in a demo account and play around in there and see how it goes. If you are a short-term trader, though, the transaction costs will kill you. You don't want to be trading a pip and a half spread. You want no spread when you're a day trader. So you can use the futures for that also. Futures, even with the little bit of commission they charge you, you can get that down to less than a pip, maybe even a half a pip. Then that's good. Who'd like to trade a half? Raise your hand. Who'd like to trade a half pip spread, right? Well, trade futures then. So if you're going to day trade, you want to do it in the futures market where a little bit less, your transaction costs a little bit less. So we look to focus on when that micro patterns are aligned with the day-to-day news flow also. No, I was serious, Ahmad, when I said that you could trade, Ahmed, excuse me, you can have a method that works in all environments. There's no doubt about it. In trending and counter trending markets, sideways and trenders and sideways markets. And here's an example of lower time frame trade. Here the day-to-day pattern for us is bullish in this picture, and this is dollar yen. Oh man, I'm telling you, December was the month to be trading. It really was. But here's dollar yen. The day-to-day pattern's up. I can see the day-to-day pattern's up because it's above my purple line. And that's just a 50% retracement. So the 50%, as long as prices are trading above that 50% retracement, at the very least, the path of least resistance is higher, right? So the path of least resistance is higher. Then therefore the day-to-day pattern happens to be higher too. And here again we've marked, see these lines here? These are just retracements. And that each green, the purple and the green line, that's the same retracement every time. So you had a rally, then you had it came back, held it, rally, came back, held it. Here the 50%, the purple line held. And here once again, double bottom on that purple line. So that's what we look for. So each one of these retracements pretty much the same thing, and this is dollar yen, and this happens to be on an hourly chart. So if you're a swing trader wants to be long here, here, and here. Now, there's going to be a behavioral aspect to exiting that trade for sure. We'd love it if it was always as simple as wait for the MACD to cross, but you wait for that MACD to cross, that could take a lot of your profits back, right? So there definitely has to be a behavioral aspect to exiting trades, and that's going to be based on how much the risk on the trade was, and maybe we could use see that moving average, that those two moving averages, very short term. We can use those also, and you could even use a multiple of what you risked. As long as you're taking out more than you risked, then that's a good thing, right? So. Dollar yen, this is an example of a short-term chart where the overall pattern was higher, and it may look real sloppy to us, it may look even scary to us. Look at a big gap up, rip down, but it's holding the pattern, and if anything, this is a thing of beauty because these are all the same retracements. Those green lines represent the same ratio every time. The purple line happens to be a 50%, so you can see the value of that. So pretty simple stuff. Not easy to do. It may take you a couple months to pick up on that to have the confidence, but it's a pretty simple method overall. Why do most retail traders not succeed? See, I won't even say fail. That's a negative word. Why do most retail traders not succeed? We don't ever talk about this in class. We try to focus on what does work. We try to focus on teaching you what does work and demonstrating that and getting you to demonstrate it to yourself. But I think it is apropos that we do cover this now, given that we really don't know each other. You guys aren't necessarily students of mine, so if there's one thing I could turn you on to, it's to point out what you may be doing wrong. We don't get a chance to do that in our courses because obviously we want to focus on the positive. One of the biggest reasons why people lose money, as Ahmed said, that most day traders lose money because they have a preconceived idea of what the market will do, which is supported by what they see and they read. It's amazing, and we all do this too. I mean, you do it as a little kid, right? You get a good grade in school, and the teacher gives you a star on the paper or says, "Hey, you did great." So you're going to go home and you're going to show that paper to your parents, and they're going, "Wow!" They're going to pat you on the back, and the other kids are going to be jealous, and the girls are going to be impressed that you got a 98 on your test. Well, that's what we do, and that's normal. We look for support. We want other people to support us. We want them to see that we succeeded. We want that pat on the back, okay? So that's why if we have an idea that the euro is going to go down, then we subconsciously seek out reading material that supports our belief that the euro is going to go down. We have a preconceived idea of what the market will do, and that's great when we're right, okay? But what happens is you hang on to that preconceived idea. You're looking for a desired outcome. When you hang on to that outcome, what's going to happen is it's going to create an energy block. Anytime you're having attachment to an outcome, you're blocking yourself from seeing the other possibilities there. And oftentimes, you may not get the exact outcome you want, but you can get a better outcome. But you may not get that better outcome right away. You may have to sit through a drawdown. You may have to sit through a 50% retracement. You may have to hold your stomach there, and you may have to sit there and do the right thing, and then that market goes your way. Then it starts going your way, and then, bam, some news comes out and it breaks, and it's just going and going and going your way. Well, you were cursing that market 20 minutes before when it was going against you, weren't you? Because it didn't do what you expected to do. So when you get attached to an outcome, it's going to make it hard. It's going to create a hard time for you, because when you get attached to an outcome, you're not going to see what could happen differently. And it's very important as traders to not have that preconceived idea. It's very important to keep an open mind, because more times than not, you think you're getting short and you want to just go your way. A lot of times it'll go back up and retrace, or maybe put in a double top, and then it'll go big. The market has to sweep out the last shorts or the last longs. It's got to get rid of everyone. It's got to get rid of the weak hands in that market before it can move big. It's got to sweep everyone out of that trade before it can go your way. So don't get hung up on that preconceived idea. Most people do this, and then they're amazed that 3 days later they were right, but they lost money. And then they're going to go around and they're going to tell you about it. Like, oh, man, I was right that euro, and I got stopped out right on the high. Well, you didn't have that behavioral component to your methodology, and you didn't believe in the mechanical component enough also, is what's happening there. So don't have the preconceived idea. Please keep an open mind. And also, don't get discouraged when you have a hard time initially trying to have an open mind. You're going to go back to what you know. It's just, it depends on your age. You take a 40-year-old guy, I guarantee you for 35 of those years, he's been walking around looking for that pat on the back. He wants to think that he knows what's going to happen next. That may be his identity, especially maybe he did really well in school. Maybe he got straight A's in school. He's always used to being right. He's right. His identity is he's a guy that's right. Well, he's not going to do well trading because he may not be able to see things changing. He may not see the market for what it is because he already has that preconceived notion. So get past that. You have to get past that. Number 2 reason people lose is they don't have a sound understanding of risk. They're just not experienced with risk. A professional trader, an experienced trader, they're well aware of risk because they didn't start out a winner. Nobody starts out winning in this game, okay? They had to learn the hard way. They had to sit through drawdowns. They had to gut it out. I mean, they had to sit in that trade and put that stop there and sit there when that market went against them and almost stopped them out. Then came back and they got to the point where they were break even. Then it went back up against them again and they drew down again. They've sat through that because they had generally that have mentors that provided their money to trade with. That's how it worked in Chicago. You got a job at the prop shop and the professionals, they trained you in a demo account, then they gave you money to do it. So you had to do what they told you to do, otherwise they'd fire you, right? But that experience was great because you learned to sit through a drawdown. You know that you're not going to get your way all the time, okay? You have to follow the rules, otherwise you're going to be out of a job. Unfortunately, most of us aren't going to fire ourselves. So it's very difficult to learn how to trade if you're self-taught because it's a hard thing to fire yourself. So you have to have an understanding of risk. If you can't afford to take the risk, you can't afford to take the trade, right? And you have to understand that everyone has that risk threshold, that when that market gets to that point, they're going to get swept out. Here's the beautiful thing about that. When you take, given that everyone has that risk threshold point, when you take that point collectively, that is all traders on that that are trading that time frame, that collective price point where they're going to cry uncle, where they're going to throw in the towel, is going to be right around that Fibonacci number. So you take that the risk threshold collectively, and it's actually a pretty predictable level. I showed you guys dollar yen today, right? That dollar yen 1 minute chart. You saw how it just kept repeating itself. Well, it would go a little bit beyond that risk threshold, stop out the longs, turn around, and go right back up. That's what markets do. It's fascinating. Well, that's what professional traders do. The professional trader is just the cumulative, the market is just the cumulative effect of the professional traders, right? So you have to understand risk to make money in this game. And people don't understand the importance of using market-generated setups and signals. The market has to give you the setup. You're not going to provide the setup. You're not going to say, hey, this is where the market's going to stop. You have to let the market do that for you. I'll give you an example. Here's the yen, the daily yen chart. Okay, see that orange line up there? Where did that orange line come from? Here, let me go out to a weekly chart. I'll show you where it came from. You go back to the 2010 high. That's our long-term primary pattern. You draw a slide or retracement out, and the market itself gave me that level. I just didn't pick that spot out of the air. The market did. So I'm aware that that's an important level for the market ahead of time. So that's what we mean by market-generated setup. That doesn't mean I'm bearish just because it hit there. The majority of my patterns are still higher. But I'm cognizant of the fact now that the primary pattern is bearish, right? The only time a long-term pattern is relevant is when you're right at structure. So we're at long-term structure. That's a weekly chart. I'm going down to a 4-hour chart. There you can see that double top against that level. Well, I'm certainly aware of that. That doesn't mean I may not take buy signals if I get the right setup, but I am aware that that primary pattern is down. So that's exactly what we mean when we say that you're going to use the market-generated setups and signals right here. Understand the importance of market-generated setups and signals. So how can we help improve your trade selection? Oh boy, I better hurry up. I wasted a lot of time talking here, right? So that's the million-dollar question. How can we help improve your trade selection? I've been doing this a long time. As I said, it took me over 4 years to put together our trading course. And what you need to know is know when direction is aligned with price pattern. That's essential that you know when direction is aligned with pattern. You have to know when to enter a trade. You have to know how to manage that trade. So you're not, essentially this is our trigger at Trading University, when direction is aligned with the pattern. And if I'm going to tell you no one direction is aligned with pattern, I need to define direction. Boy, I am way behind. So we may have to fly through these. Change of direction. Directions, it's not necessarily direction, it's a change of direction. Because if I tell you the direction's bullish right now, then I need to go back and show you at what point it shifted from bearish to bullish, right? So you need to know when direction is changed. So we call it change of direction. It's not direction, it's change of direction. So a change of direction equals a trend line break plus a directional line shift. And we all know what a trend line break is, right? You may not know what a directional line shift is, though. So a directional line, we're going to define directional line. The directional line is the low of the highest closing candle in an uptrend or the high of the lowest closing in a downtrend. Directional line would be used is if price is closing below the directional line, direction is down. If price is closing above the directional line, direction is up. Let's give you an example of that. Let me go back and give you the definition. You may want to write that down. The low of the highest closing candle in an uptrend, that's going to be your, that tells you that you're in an uptrend, or the high of the lowest closing candle in a downtrend. And I'll give you an example of that. Let me go with a 4-hour chart here. I love this aspect of the chart. I wish MetaTrader could do that. See how I just made the bars wider? I can easier see it. I wish MetaTrader could come. When MetaTrader comes up with that, that's when I'll do webinars in MetaTrader. Okay, what did I say? Let me switch back. The low of the highest closing candle in an uptrend. So let me show you the low of the highest closing candle in an uptrend. That's my highest closing candle there, right? So that low is a significant level for me. And this is the 4-hour yen chart, by the way. That's the highest closing candle, right? So I just marked the low. Once you close below, that's the highest closing, not the highest candle. One of these may be the high. That's the highest closing candle, though. You want the closing candle. So that low, once you close below that low, that's what we call a change of direction. It's only significant, however, when it's in line with the pattern. Okay? Yeah, every time the market reversed here, it had a change of direction. There's a change of direction. There's a bearish change of direction. Actually, right here would be, see, that's my highest closer there. Here's a change of direction. Here's a change of direction. They're only significant when they're in line with the pattern. When the pattern's bullish like this, I want a bullish change of direction, right? So I want, when I can see the pattern, and the pattern is very simple. Here's a high, here's a higher high. Here's a low, here's a higher low. So I want to know when this market changes direction right here, that's an interesting change of direction to me because it's in line with the pattern. Same thing here. This is a bullish change of direction. Here's at the time, this is my lowest closing candle right there. If you're looking at the chart like that, okay, that's the lowest closing candle there, right? So the high of that lowest closing candle is significant. When I close above it, right there, I want to know that because that's a bullish change direction in line with the bullish pattern. You take that, you better put that stop where it should be. Here's what I talk about risk. What do you think happens if you go long here? What do you think your average person is going to do if they go long here and this happens to them? They're going to panic. They're going to, oh my God, I'm long. I'm getting out of that trade. What happened? They got out at the bottom. If they had their stop just a little bit below that low, what happens? They have a winner. But in reality, if it gets right back to where they bought it, it gaps open on this day, they're getting out. They're getting out and they're happy. They're like, whew, that was close. Instead of managing that trade properly and then really capitalizing on it. So hopefully you guys get that, what the change of direction actually is. All you're doing is marking the low of the highest closing candle in an uptrend and marking the high of the lowest closing candle in a downtrend. It's only significant when it's in line with the pattern. Most people, it's amazing how they want to go short here. They want to go short here. They want to go short here. Well, here they may have actually worked. They may have a little lead on it. I think that has a lot to do here. I'm better off showing you this chart because it had my resistance on there too. Now this change of direction does happen to be in line with the long-term pattern, right? That's a change of direction. And it does happen to be, if I go all the way out to my weekly, we can see finally that you're against long-term resistance. So potentially a change of direction here could be in line with that long-term pattern, right? But if I'm just trading the 4-hour chart, though, I'm much better off looking for a change of direction in line with the pattern, which happens to be bullish. So it's amazing how people, they want to get short here, they want to get short here, they want to pick a top. You got to get the meat in the middle. You got to get the meat in the middle of the trades. Once you're good enough to get the meat in the middle, once you respect trends, then you're good enough to actually start picking tops and bottoms. But you just definitely don't want to make it a habit of trying to pick tops and bottoms. So direction line is used as if price is closing below the direction line, direction is down. If price is closing above the direction line, direction is up. Direction is very important, but pattern is even more important. Think of direction as a very short-term trend. Think of pattern as a very long-term trend. Basically, you want to trade when that short-term trend shifts in line with that long-term trend, right? Here's an example of it. Let's not forget the trend line. You have a change of direction, but if you don't have a trend line break, it's no good. Here's a great example. Price reversal equals a trend line shift plus a directional line shift. There you go. So here, that's the highest closing candle. Once you close below both the low of the highest closing candle and the trend line, that's a bearish development. That's a reversal. So a change of direction equals a reversal, particularly when it's in line with the pattern. This is just, we're giving you a canned example of it. There's a bearish change of direction. Here's a bullish change of direction. You need to know these. Even if it's not in line with the pattern, you don't know how far that counter trend line could go. So what you need to do then would be exit. You may exit a trend trade on a counter trend line signal and try to reposition yourself at a better price, right? So regardless of whether the change of direction is in line with the pattern or not, you need to know that it's there, because you may choose to exit that trade. You don't want to sit. Maybe you don't want it. Maybe it's late in the week and you just don't want to take a position home over the weekend because it's going counter trend against you. You never know, news can come out. So you may opt to exit that trade on the counter trend signal. But once again, I think this same chart will highlight my point that you definitely do not want to be taking a change of direction against the pattern. Even going back, boy, this is a great run, wasn't it? Now, when you see that the pattern is bullish here, why would you get short there? Yeah, that's a change of direction right there. Let me blow that up so you can see it. I love this function on that chart. Why can't MetaTrader do that, right? See, this is a change of direction. This is the highest closing candle right there. And then you close below the low of the highest closing candle, change of direction. Look at that. Your moving averages cross down. Even the old MACD. Even our boy, the old MACD, is giving you a sell signal, right? Yeah, but you don't want to take that sell signal because the pattern is bullish. You're looking at it. That's a higher high. This is a higher low. This is a higher high to back here, and that's a higher low to back here. So you only want to take a change of direction in line with the pattern. Okay, and you always have to be mindful of what's going on those higher time frames too. It's so subtle. I mean, look at here's a higher high, right? There's a high, here's a higher high. I see that like that. Okay, that doesn't get past me. Traders want to say, well, that's a big shooting star. I'm going to take this sell signal right here. See how everything's going down once again? Everything's telling you, all your indicators are saying, hey, get short. I'm not going short. That's a higher high. And this happens very subtle as it is. This happens to be a higher low to that, which is definitely a higher low to back there. So you always have to be cognizant of that pattern. And we see the very same behavior on the lower time frames as we see on the higher time frames. And that is the beauty of fractal geometry. And those are just canned examples of it. So the key is taking that change of direction signal when it's in line with the pattern. You still have to know that it's there, though. You definitely want to know that it's there because you maybe happen to be long in a trending market and you get a counter trend signal. You may say, well, I'm just going to bail on this and maybe try to get in lower. Or, maybe it's your day trader or your shorter term trader and it's getting close to the close and you're like, well, it's a counter trend signal. I'm just going to bail on that. So we will use counter trend signals to exit trades, but never to enter trades. That's kind of It's just kind of common sense, right? So here's who we are. There's our website. That's a picture of me. I need to change that out. Actually, that's crazy to show a picture of yourself when you're talking in a webinar. At any rate, that's our website. Here's our offer. Enroll in our 6-month master's trading program. That's $199 per month. So it's $20 pips per month. So you risk 20 pips per month, and you receive everything up front. You get the core. You get all this is on video on demand. You can watch it 24/7. Come in our online campus. Go to our online campus, and you can register. And you get everything up front. You get the core concepts, advanced concepts, graduate course, and master's class taught in the live markets and archived. Now, you can come and sit in on the live master's class with us, or you can review the archives. You can actually review the archives of the previous semester, too. So you get all this your first month. If you don't like what you see, if you don't think the advanced course, graduate, and master's courses, that there's not enough there for you, or you think you already know all that stuff, then you're certainly not going to continue to pay us the $199 a month, right? So you can opt out of that at any time. Along with that, you get one-on-one mentoring and our office hours. You get the Skype chat where you can be in the chat room with the other students, and I'm in there more and more in the London session. You receive a copy of our risk tolerance threshold theory, and you get the emailed alerts. You receive market alerts that utilize the methods taught. Basically, we send you those ratios so you can see how the markets are aligned, and that's going to be a big bonus for you as far as helping you out decide which market to trade and when to trade that from, right? So that's who we are. Now, we talked about direction. We really didn't talk about price pattern that much either. Price pattern, pretty simple. It really is pretty simple stuff. Take a chart, mark the isolated highs, mark the isolated lows. There's your pattern. Draw a channel line, and boom, there's your pattern. It is that simple. Now, we drew this back in April. That's 9 months ago. What happened? Well, the euro came down here, and it went up here, right? So it's still within that overall pattern. That grand pattern still holding. So, and we drew this 9 months ago. The market went down, made a lower low. Now it came back up here. It hasn't made a higher high yet. It's still below that 135. What the market's in here somewhere. So it went down, came up. Now it's going sideways, right? So for all that noise, all the great news and Mario Draghi's effect on the market and quantitative easing and the fear in Europe and the Greek situation, this chart's 9 months old. It's still within that pattern. It went down almost to 120, came up above 130. Big deal. That's what markets do. They go up and they go down. So we teach you that it's not a big deal, that that's normal that markets move like that, and we teach you how to move along with them. And here's a price pattern in the U.S. stock market. Beautiful thing about price market highs left there, it's scalable. See those three patterns up there, the three Elliott wave there? Now boom, boom, boom. It did the same thing on the higher time frame. So this is a two-way mechanism. The price action you saw in that lower time frame happened to be replicated on the higher time frame. That's a two-way mechanism. You'll see oftentimes what happens on the higher time frame is replicated on the lower time frame also. So pattern is a beautiful thing. It's a pretty simple thing. And right there's your change of direction in line with the pattern. So boom, boom. All we're doing is we're looking for that change of direction in line with the pattern. Simple stuff. I better wrap it up here. As always, we're running out of time. And here's an example. We use that pattern as a trend map. And this is what we email our students. We email this out on a regular basis. And again, you see the Aussie dollar, the pattern's very bullish. All the patterns are bullish. Therefore, we're looking to go long. And we're looking for a buy signal in that zone. Number one, we're looking for the zone to hold. What really happens here is everyone else all the other longs get stopped out. Anyone who bought it here on the way up, they're all going to get stopped out there. So we want to see them get stopped out. Then it holds our level there. As long as it doesn't close below it a couple of times, that level's good. It even gave you a bonus close below it to run any shorts out. And then as the market changes back direction higher, see there's bullish change direction right there in line with the pattern, because here's a high, here's a higher high, here's a low, here's a higher low. So as long as I have a higher low and a change of direction, that's going to be a good change of direction. But if you look at the date here, this is 12/7, a Friday. I emailed that out to the students, and this is 12:10. This is Tuesday. So the patterns were still bullish 2 days later. So when a bullish pattern, we're looking for a bullish change of direction. And it held this long-term support here, too, it looks like. So we use the pattern as a trend map. And here's just another example. Here's the euro. On 12/7, we emailed that out. And despite the 15-minute pattern, or that 15 micro being down, and that 15 micro, by the way, that's as much as a week. That could be as long as a week. So the primary was down, and that 15 micro was down, but the meat in the middle, everything else was up. So when it's up, we're looking for change of direction in line with the pattern. These buy zones are a bonus for us. See that same retracement. So here's a bullish change of direction in line with the pattern, and we know that ahead of time. Boy, December was a great month. It was just a great month. So that's all we're showing you is you want to take a change of direction in line with the pattern. So I better wrap it up here. And this is just an example of scalability. Otherwise, we're gonna run out of time here. And if you want to know more about what we're doing, here's just another example of a long-term pattern. This is a grand pattern, weekly chart. Here's a change of direction right there. Change of direction. What happened there? The market dropped all the way to 120. So you want to take a bearish change of direction in line with the overall pattern. So we hope this demonstration helped you out. If you want to know more about what we're doing, come and see our website at TradingU. You can email myself or email info@TradingU. And once again, here would be the offer. For $199 per month, you receive all this up front too. So you pay 20 pips. You pay 20 pips, and you get access to everything up front, including last semester's master's classes archive. So you have the full 30 days to review everything we're doing. Take advantage of get that risk tolerance threshold in your hands. Take advantage of viewing everything. See for a month how effective those risk tolerance studies are. We email that to you. When you get it, you want to see the next couple of days how effective they were. So we look forward to meeting you guys. I think one of our, Fernando, is that you, Fernando Marquis? Are you with us? Fernando's a student of ours too. So always a pleasure to see you guys, and we look forward to seeing you guys tomorrow. We're here to do it again, and also we look forward to seeing you guys come to our site. Let me back it up here. Come to our site, and you can demo. Just go under. Here, I'll go back. You just look under. Here it is. Go under education, and there's some demo opportunities. You can go in there and you can demo our live market analysis, which is coming up Thursday, and all that good stuff. So, hey, as always, thank you so much, and we'll see you guys back tomorrow, and when we'll look at the patterns in today's markets. And we look forward to continuing seeing you guys in the demos, and we look forward to you guys seeing you guys as students of ours in the current semester. So thank you so much.